Sure. So basically, today we are going to discuss about SPAC, Special Purpose Acquisition Company, and it has really become a buzzword in the financial world right now because many companies, they're adopting this route to list themselves on stock exchange. The perfect example from Indian context is basically Renew Power, which got listed on Nasdaq on August 24 through the SPAC route. So today we're going to discuss what exactly SPACs are, how they're formed, and then we're going to discuss about the valuation of founder shares in SPAC. So SPACs are basically blank check companies, so what they do, so how they are formed, those certain fund managers who have experience of investing into different companies, they come together, they form an entity called Special Purpose Acquisition Company. And as a company do not have any commercial operations. So it's a blank company, not listed themselves on any stock exchange, could be Nasdaq, New York Stock Exchange, with a clear objective that within a specified period of time, which is generally 24 months, that they're going to acquire a privately held company. And then that privately held company will get merged with the listed entity, which is a SPAC. And then accordingly, by doing so, that private company become a listed entity. And then they ultimately get the opportunity to get themselves listed on Nasdaq, New York Stock Exchange, or any other stock exchange. So this is what SPAC does. So they form a blank company, get themselves listed on stock exchange, target, merge that target with SPAC, and then enable that target to become a listed entity. So if we have seen in the recent past, in last 2 years, the SPAC route has really got a lot of traction. And within the US market, like in 2022, there were almost 248 SPAC IPOs, and overall $83 billion of funds were raised, compared to 13.6 billion in 2019 and just 3.2 billion in 2016. So you can see the kind of traction which SPAC is now getting. And therefore, going forward, even markets like India, Asian market, other Asian markets, they definitely will get a lot of traction towards this route. And therefore, it's important for us to really understand this concept. So here I have presented a graph, and we can see like in 2022. So the light color basically represent the traditional IPOs. The dark color shows the SPAC IPOs, and you can see that in 2021 also the proportion of SPAC IPOs were significantly higher than the traditional IPOs. Now, moving to the next slide, which basically talks about the structure of an SPAC. And it is important to understand that how SPACs are structured, how they work, and what are different instruments which get issued in this structure. So as I mentioned initially, what happens, certain fund managers, they come together, they form a holding company. And that holding company then form a company called Special Acquisition Company. They list this company on a stock exchange. And through a list, they raise certain amount. It could be $1 million, it could be $500 million, it could be $300 million, so whatever amount they raise. Once they raise that money, they put that money into a trust with a clear objective that they're going to use that money for an acquisition. So what happened, whenever they form a special acquisition company, the initial founders, they put a nominal amount, a very small amount, to meet all the expenses in relation to registration and listing of this entity. So whatever the expenses which are required for IPO, they put money in the entity, and they subscribe to founder shares and founder warrants in SPAC. And I'm going to throw more light about what exactly founder shares and founder warrants are. And then public investors, they put money. This is the amount which SPAC raised, and they subscribe to public shares and public warrant in this entity. So once the IPO is done and the money is is put in a trust account, then the SPAC company, they start looking for target. And again, this depend what kind of target they are going to find and what is the investment thesis of this aspect is everything mentioned in the prospectus. And so, for example, if this is an aspect for maybe for renewable energy, they will identify in that segment. So once they identify target, they do a negotiation, enter into an agreement, and then they go to the shareholders and investor for an approval. So if the approval comes, then that company get merged with SPAC and become a listed entity. And this process is called DSPAC. And this entity which they identify become a listed entity. But if they are not able to get shareholders approval, or if they are not able to identify any specific target within a period of 24 months on an average, which is generally allowed, then they have to dissolve SPAC and return that money back to the public investors. So therefore, from a public investor perspective, their money is in a trust. So therefore, if the transaction does not happen of acquisition transaction, then the entire money will be refunded to public investors. So this is how this structure broadly works. And in this structure, like here, the public shares are listed, so there's no question of any valuation. The acquisition of shares or the acquisition of company here, it depends upon negotiation between the fund manager and the promoter of that private company or investors of that private company. The question arises, which is a very interesting part, is the issue of valuation of founder shares. So what happened? Move forward and give you a perspective. Here I have listed down this few steps which I explained earlier. That when SPAC is formed and the founder shares are issued. So typically in this structure, what happened? The founders they say that okay, on day one, they're not putting much money. They just put a small amount to meet the expenses. And the majority of funds are being invested by public investors. But they're entitled to get 20% interest once SPAC acquires the target. So if we go back to the slide, so once SPAC, so before any acquisition, SPAC is just a blank company where entire money. So suppose if this SPAC is raised $500 million, this entire money belongs to public investor, and technically founders do not have any interest in this company. But the agreement says that, or the prospectus and all the related documents says that once this SPAC acquires any target, then the founders, the ultimate shareholding of this SPAC will look like 20% will be with founders and 80% with public investor. So this is the broad section of the shareholding between the founders and public investors. So ultimately, if founders are able to identify and acquire a company, they will end up getting 20% interest in a SPAC. But if they are not able to identify any target or not able to complete this session, so then the entire money will be returned to public investor, and founders will not get any capital or any money. So therefore, the value of the interest may end getting. I would say the founder's share is more like an option in the company where it gets value only if certain milestones are achieved. So therefore, this is important task to really understand how to value founder share. So, and this is what we are going to discuss in today's presentation, because how the negotiation happened, how this entire structure is created. I think it's quite technical and it requires a lot of I would say session. But in the first in today's discussion, we're specifically going to focus how to value founder share. Because as I mentioned earlier, the founder shares is something they will drive value only if SPAC is able to raise money. And there are a few more writers which are associated with founder shares, which I'm going to discuss with you as we are going to talk about the valuation of founder shares. So in these slides, I have just noted out the steps so that once you again refer this presentation, you can read those points. But I have broadly explained while giving you an idea about structure. So About the deal cost is something which is being funded by the founders itself. So as I mentioned initially, that the founders, they put the money into the company to meet all the deal expenses, and therefore they have to return the entire money back to the investors. So all the deal expenses have to be borne by founders. Now, I just put a case study here discussing about Renew Power listing, so which is being got merged with RMG Acquisition Corp. So if you look at the entire chronology of event which happened in this case, so in February 2021, Renew Power and RMG announced a deal that they are entering into a business combination in Feb 2021. It happened, and finally, Renew Power got listed in August 2021. So you can see the time frame of which enables Renew to list on stock exchange. So earlier also they tried through a direct listing route, but they were not able to achieve it. But through SPAC, Renew Power able to list itself on the stock exchange within a very specified and limited time frame. So if we look at the chronology of event, in October 2020, RMG Acquisition Corp as a SPAC was formed. And then in December 2020, it came with an IPO, got itself listed on stock exchange, raised $345 million. In February 2021, it entered into a business combination with Renew Power, and then finally listing happened on August 24. And now the RMG Acquisition Corp 2
Amrish, you're on mute.
I think, yeah, now it's on mute. I don't know what happened. Yeah. So, Raj, I think now everything is going fine.
It's better. Not 100%, but it's better.
Okay, sure. Thank you. Yeah. So now RMG Acquisition, it has been renamed as Renew Energy Global PLC, and now it is being traded on the stock exchange. And as part of this entire transaction, the enterprise value what Renew Power got was almost $8 billion and an equity value of near about $4.4 billion. And in this process, they raised almost $610 million, both through route, and they had a private placement before this transaction. So this is the overall transaction and the chronology of event, and definitely this is one of the, I would say, successful transaction which has happened from the Indian perspective, and Renew Power got good valuation in the entire process. Now to the next slide, where we are going to talk about founder shares and how to value those founder shares. So when I presented that corporate structure, we discussed that different instruments are issued in this entire structure. So 4 major instruments include founder shares, founder warrants, public shares, and public warrants. So shares and public warrants are something which are owned by the investors, and they are listed on the stock exchange. Founder shares and founder warrants are something which the founders will be entitled to get once they achieve a combination, or once they're able to acquire a company. And on acquisition, the founder will ultimately end up getting 20% interest in the company. But so for example, if the SPAC has raised, say, $500 million, and accordingly the market cap of SPAC is, say, $500 million before any acquisition, we know that founders are going to get 20% interest in that company. So are we going to say that the worth or the value, the market value of founder shares SPAC is going to be $100 million, which is 20% of $500 million? The answer is no, because as I mentioned earlier, that this is going to happen only if SPAC is able to complete the acquisition. Otherwise, the entire money will be funded. This is one. Second, there's few other riders which is involved. One is the lockup period, which is being which is a requirement that founders cannot sell their shares for a certain time. And there's one more adjustment which was called 4 features of founder shares, which we're going to discuss in detail.
Amrish,
So therefore, we are going to
just to
discuss that
interrupt
how those
you,
adjustments will
Amrish, can you
factor
hear
in.
me?
Yeah, I can hear you, Raj.
Small interruption. Even Gandharv has also joined. So in case if there's an issue with the voice and all, so I think he can also talk. Gandharv
Okay.
from your firm, he is also joined just for a backup.
Sure.
Yeah.
Okay. Sure.
Okay. Thank you.
Thank you. Yeah. Sure. So therefore, there are few adjustments which are required to really arrive at the fair market value of founder shares, and we're going to discuss those adjustments. So basically, these are the three type of adjustment which has to be made whenever we do a valuation of founder shares in SPAC. The first adjustment is about the forfeitures of sponsor shares. Though, as I mentioned initially, that founders are entitled to get 20% interest in the SPAC, but practically, what we have seen that whenever acquisition transaction happens, basically founders have to forfeit some of the shares to ensure that the transaction happens, because during negotiation, sometimes founders have to let go their interest in the company because they see that if that transaction do not get through, maybe they end up getting zero interest in the company. So therefore, practically, it has happened that the founders, they forfeit some interest in the company, and based upon different historical trends, on an average, what we have seen that founders, they let go almost 20 to 50%, or maybe in some cases up to 50% of their interest in aspect to ensure that the acquisition transaction happens. So therefore, this is one adjustment which we have to take care while doing a valuation of founder shares. The second is definitely about the probability of successful business combination, because if the business combination doesn't happen, then founder shares will have zero value. So again, based upon historical trend, there are few analysis and few data points already available given the actual history of aspects. And based on that, we have seen that on an average, there's almost again 10 to 20% chances that aspect may be able to identify a company and complete the acquisition. In that case, they had to return the money. So based on historical trend, that adjustment factor is almost 10 to 20%. And at last, under regulations itself, there are certain lockup period for founder shares, and therefore, since the founders cannot sell those shares during lockup period, an adjustment has to be done for discount for lack of marketability. So these are the three adjustments one has to do whenever they're doing a valuation of founder shares in a SPAC. And through a practical example, I'd like to present and discuss with you how those adjustments can be done and how we can value founder shares in a SPAC. So just take some hypothetical inputs, assuming that if the traded price of a SPAC is say $12 before acquisition, traded price of warrant is assuming like $2, and founder shares are almost 6 million, founder warrants almost 7 million. So practically what will happen that if everything goes as per plan, founders will ultimately end up getting 6 million shares in SPAC, and without no correction and nothing happened, founders' worth of shares in SPAC will be basically 6 million multiplied by $12, which is basically almost $72 million. So, and for warrants, it will be 14 million. So this is a plain vanilla situation where we say that, okay, if everything goes as per plan and the founders is going to get 6 million shares worth of $12. So $12 is basically the listed price of those shares, of public shares in which ultimately founder shares will get converted. So therefore, as a starting point, we'll say that the value of founder shares will be 72 million and warrants will be 14 million. The total value of founders interest in aspect will be 86 million. Moving to the next slide, which talks about the first level of adjustment of regarding the forfeiture of shares. So here I've listed three studies which has been done, or three analysis which has been done. One was a Harvard Law School, second was Stanford Law Professor, and third is being an article published by Vincent, where they have analyzed that what is the forfeiture amount, or how much interest has to really forfeit in order to ensure that successful business combination happen. And all the studies ultimately present a data point that almost 20% to 50% founder shares were forfeited. So accordingly, we have to make an adjustment for that forfeiture factor. And therefore, the value will reduce by 20%, assuming that if transaction happen, the founders may have to go away with 20% trust company. So this is the first adjustment. So from 62 million, we reduce 20%, will end up almost like 57 million. The second adjustment is basically the probability of successful business combination. Again, different studies have been done, one by a McKinsey & Company, another an article published on read.com. And there's also a lot of data which is available on spacdata.com about SPACs. So if we look at all those data points, almost like there's a 80 to 90% chances that SPAC will successfully will complete the merger. And therefore, there's almost 10 to 20% chances that they may not complete the merger process. So accordingly, an adjustment will be required. And if we look at this slide, we have basically taken two scenarios. The business combination happen, the value will be 57 million, and the probability factor for this will be 90%. And if business combination does not happen, then the value will be 0 and a probability factor of 10% on the same. So therefore, we accordingly calculated the weighted average value. And finally, the final adjustment is in relation to the lockup period, which I told that generally there is a lockup period which may vary from 6 months to 1 year for founder shares. And we have to make an adjustment for discount for lack of marketability. And there are different, I would say, empirical studies and methodologies which are available to calculate the discount for lack of marketability. So some of the put option pricing models are there, which include Chaffee protective put model, Finity, average strike, methods, long staff. So there are different models which are there, which we can use to calculate discount for lack of marketability for the specified period. And by using this model, we have seen that generally the discount ranges between 15 to 20%, and therefore the final adjustment we have to do is basically adjustment for discount of lack of marketability, again of 15%. So ultimately, the value will end up getting almost like to a level of 54 million. So if we see the conclusion slide, from a 72 million, the value is really reduced to 27 million, which is almost a 39% downward adjustment to the overall value. So this is how we value founder shares in a SPAC whenever it's required. So from a Indian context perspective, since it's early days for SPAC, but this we have been doing in the US market, which has become matured, and many SPACs have formed, and the founders who are having shares in their founder shares in SPAC, they are asking to share. So this is one of the methodology that we adopt to calculate the fair market value of those founders, and accordingly we make assessments for all the three factors. So I'm going to summarize those three factors again. One is basically the forfeit risk, because practically founders, they do not end up getting 20% interest. Post addition, they get a lower interest, and therefore a risk adjustment has to be made for this. Second is the adjustment in relation to the probability that if SPAC is not able to complete the acquisition and SPAC, in that case, the SPAC has to dissolve and return that money back to the investors, and therefore the value of founder shares will be 0. And the third is in relation to the discount for lack of marketability, what we have to capture. And so after making all those three adjustments, ultimately the value will be reduced. And this is how we calculate the fair market value. So with this, I'd like to conclude this session and like to say thanks for giving an opportunity for sharing this for sharing this concept with you, and really sorry for the IT issue which happened today. The question comes that to explain a lack of marketability. So definitely discount for lack of marketability is something because the founders, they will not be able to sell their shares for a certain period. So there's a requirement that even after SPAC is formed, they cannot sell their shares for a period of 6 months approximately. So if we are calculating the fair market value, and we know that SPACs we know the founders are not able to sell their shares for that period. So therefore, there's a requirement to make a discount for lack of marketability. The different put option models, I'll explain a very simple, straightforward model, which is a put option model. So what we do in the put option model, so if you are aware about put option analysis, what we do in option that we get right to sell a share at a particular price. So what in put option analysis, what we do, we keep the strike price and the exercise price same, and calculate what is the put premium. So that put premium basically reflects that by paying that premium today, the investor sure that they will get the value equivalent to the spot price after certain period. So assuming that today the value of the company is say $10, and there's a restriction that for next 6 months they cannot sell the shares. So just ensure that after 6 months they're going to get $10. So an investor can buy a put option with $10 price, and whatever the put premium they have to pay basically reflect the cost to the liquidity, and that cost basically could be used as a discount for lack of marketability. So this is a put option model what we can use. So I hope that clarified the point on lack of marketability. Then I could just give me a minute. Just let me open the chat box again. And this is the aspect form keeping a target in mind. No, so generally the aspects are not formed keeping a target in mind, though they clearly identify the sectors in which they are going to make acquisition. But the target is not known either to the public or to even to the fund manager on the date of formation of SPAC, because there is a really confidential information, and therefore only after getting listed they start basically identifying targets. So target is not known on that date. Sure. So
Amrish, your voice is somehow cracking. So even if Gandhar want to answer, can he answer?
Yeah, sure. Yeah, Gandhar, hi, welcome.
Yeah, Gandhar, if you want to answer, you can answer in between.
No, I think Amrish, I think I'm able to hear Amrish. In case there's any issue, then I can maybe pitch in at any point in time.
Yeah, because still his voice is cracking in between, right? So if you would want to answer a few of the questions, Gandhar, I think your voice is much clearer.
Okay.
Okay, so you can probably look from bottom, the question from Rajan. SPACs are formed target industry in mind. Then there is a second question. Then how do you raise funds without having a valuation in mind? So you can
just to answer this part. Sorry, maybe then Gandhar will pitch in. So just to answer this to
Amrish, I think you should take it up in case I can repeat what you're saying. So I think that would be better. I can maybe embellish and then repeat what you're saying.
Sure. So generally what happens when the SPAC get listed on exchange, they always get listed at a price of $10. This is a standard price that we list. No valuation is done at the time of listing of SPAC, because very clearly they get listed with as a blank check company, and the market cap is almost equal to the total funds which they raise, and the initial values always remain at $10. As SPAC move forward to their journey, and once some news start coming that okay, SPAC is going to is in discussion with certain companies. So this is a complete process. So whenever they enter into term sheet, they have to make a disclosure. Whenever they enter into an agreement, they have to make a disclosure. When they complete the acquisition, they make a disclosure. So at each disclosure, certain movement in prices happens. So we were doing valuation for one aspect, and we have seen that as that aspect was moving closer to acquiring a company, the value from $10 it increased to almost like $15. So therefore, the price movement happens only when there's some I would say some news in the market regarding acquisition. But at the time of listing, it always happened at $10 without any valuation of aspect. And from a target industry perspective, definitely there's target specific specs, and very clearly the entire investment thesis is mentioned in the prospectus, that what kind of companies they're going to target, in which industry, size, geography, everything is given there. So regarding target research, I would say that I'm sure whenever they go for any SPAC formation and other thing, already as a fund manager, so these are the people who already have a lot of experience in doing funding. So therefore, I'm sure they always informally would have understanding about which companies they could target. Maybe they could have informal discussions with them, but on paper, it will never come that, okay, the SPAC is getting formed to acquire a specific target. This is something which is, I would say, haven't come. Maybe going forward, some regulations are changed, but fundamentally, the concept is that all these companies are formed as a blank check companies, and therefore, because if someone forms with their mind that they're going to acquire one particular company, then it's more about one is directly listing that target company only. So therefore, maybe informally, the target could be in mind, but it will not be mentioned in a prospectus that, okay, this SPAC is specifically formed to acquire that specific target. I would say definitely this the entire concept. The question is growth in just a hot market fallacy. I would say it's definitely right now it's buzzword. It's difficult to say anything about market sentiments, and this is all about I would say market sentiments. So this is, I would say, it's just a alternative to a traditional IPO, which enables companies that themselves listed, and so it's somewhere between a private equity fund. So instead of like generally we have fund managers, they form a private equity fund and they invest into companies privately. I would say fund managers might have found this a unique way to raise fund from public, and then it's a unique structure where they're putting money into the company and simultaneously enabling them to get themselves listed. So I would say that if we see the overall hierarchy of fundraising, like generally the startup companies, they raise seed capital from angel networks, then moving to a VC fund, then to a private equity fund, then to a buyout. And now this is a structure of funds which enables companies to get themselves listed. So again, it's a different way of raising funds and to achieve a IPO. So therefore, this I could basically my view on that part.
See, I think it's also a way of earning money for the sponsors. So this SPAC route in US is basically also taken up by people, investors there, because they want to earn money when the company gets listed. So they becomes the founders and sponsors, and they exit at the time of listing. So I think it is from that way also. I'm seeing this last question where you're saying, why shouldn't a company go for having to acquire and then list the company? So that is done because of the fact that in US it allows you to list the blank check company, and then over the period you can identify which will be the best target for that company. So that's a kind of process being followed in US market to list these entities. And you would also see that the companies who are lesser known, like just now this in there's a company in India called Renew. They got listed through SPAC route. Now, why they wanted to list through SPAC route is because they planned their IPO at the COVID time. And at that point in time, they didn't want to go for a full listing because they thought that that may not be a good way of doing it. And also they didn't have the access to the investors which that blank check company or the SPAC sponsors would have. And they can maybe probably get the company listed into NASDAQ comfortably. So I think it's also because of that companies are choosing to go through the SPAC route and not a normal IPO. Obviously, what is happening is also the fact that earlier people used to list their companies in AIM market, London AIM, and all. Now it is better to go through a SPAC route, and then it is easy. Like somebody said, it is easier than finding the right business combination and merger. So I think SPAC is better than IPO in terms of when people are conservative about how the company will perform and on the listing and all. Somebody has asked, can you also introduce the services provided by our company? So we are basically a valuation firm, boutique transaction advisory firm. Both me and Amrish started this about 6-7 years back, and we are a boutique corporate finance firm. Largely, we are 80-90% of our work involves valuation, and the balance 10-15% we are also into due diligence and transaction services and raising money for companies in both equity and debt. We have our delivery center in Gurgaon. We are working with valuation firms all across the globe, majorly in US, Singapore, and Dubai market. And we are helping our clients in delivering the best quality reports and deliverables. So we are both in onshore and offshore. Offshore, I told you. Onshore, we are working with a lot of listed clients in getting the valuation and transaction advisory services done. We are also a registered valued entity with IBBI. Both me and Amrish are registered valuers passed out from first batch of ICAI RVO. And both me and Amrish are faculties with ICAI RVOs and other RVOs and platform and study circles like IDEALS and others. So that is how we are structured.
Gandharv, a question from Rajan. Did you answer that? Raising SPAC IPO fund is easier than finding the right business combination and merger.
So basically, see, if you want to have the access to the global funds and global investors, then I think raising an SPAC IPO is a better route. What is easier or not, that is something which is very difficult to comment upon, because obviously it takes time even to find the right set of investors and to find the right business combination or merger partner. So both are equally, what I can say, time consuming. But again, the strategies are different in different situations, and what you follow is as per the current given market situation.
Yeah. So I would like to add an example here, which happened in Indian context, like grofers. There was a lot of news in the newspaper that the grofer is going to have a merger with SPAC, and they're going to get themselves listed on stock exchange. But finally, they end up raising money from Zomato. So it all depends. That I would say it's just an alternative route to raising. Maybe what will happen, whichever is easier, it all depends that on understanding with the respective fund managers and what are the overall plans of the company and the promoters. So, but it has really as a good additional way of raising fund and to get the company listed.
So I guess with this, we'll close this session. Thank you.
Any other questions anybody would have?
Yeah.
I can spend 7 minutes in answering the questions if my voice is more clear.
Yeah, yours is clear.
Okay. Anybody has got any other questions? Not related to SPAC, related to any other valuation, SPAC or anything else. If anybody has got any questions on any topic, I can spend 5 minutes answering.
Thank you, Mr. Fazle. Well, we tried our level best to make it interactive as well, and there were so many good questions which were asked in the end of the webinar, right? So, Gandharv, I think we need to close it because there are no more questions, right? Apologies for the technical glitch which was there, right? So it was one of the, I mean, nothing in our hand actually. Sometimes technology don't support you. So Amrish, it was a great presentation, but yeah, I mean, in between the technology was not helping us, right? So hopefully, I mean, we'll keep organizing this kind of webinars on regular basis, which will, obviously it is not a marketing sort of webinar, which you'll find in many companies. This is more for the knowledge for our delegates who are attending, right? So we'll keep organizing this kind of webinar so that the more information is passed to our past delegates or potential delegates who are attending our program. And like, those who are attending this webinar, they can also join our workshops with Professor Damodaran, and they can get a good discount. They can write to our team also for the same. And with this, we'll close this webinar. Thanks, Amrish. Thanks, Gandharv, coming the last and answering a few questions, Gandharv. Right.
Thanks,
so we'll look forward to see you in some other workshop. And thank you all the delegates for joining from different countries. Thank you, everyone. We'll close this session.
Thanks, Raj. Thank everyone. Thank you.
Thanks, Andy. Thanks, Gandharv, and thanks for ID Network for arranging this good valuations webinar. We look forward definitely for the next sessions as well. Thanks.
Sure.
This is Rakesh Sharma from valuation team of Citco.
Oh, thank you, Rakesh. Thank you so much.
Thanks a lot. Thanks everyone, and have a good weekend. Bye.
Thanks.